This is my Roth IRA. It is sitting at $12,500. By the end of this video, you'll know how to set one up yourself. You'll also learn how to calculate your own returns, what I'll be buying in my Roth IRA, what I'm holding in my accounts, and even if this is even right for you. So stay tuned and watch till the end to figure out why and how. My name is Bruce Wang, and I've been investing with my Roth IRA for the last 2+ years now. And me and you, we all want the same thing. When we're older, we might not want to work when we're like 60, 65, 70, and we want to retire. We just want to relax on a beach. And investing in a Roth IRA is a great way to set ourselves up for success later down that road. So before we jump in, don't forget to drop a like for the YouTube algorithm, and let's see how this thing works. So now you guys might be wondering, what is a Roth IRA and why should you be investing in one? So basically, a Roth IRA is an individual retirement account, and many Americans use this to become a tax-free millionaire when they're older and ready to retire down the road. The earliest that you can retire with a Roth IRA is 59.5 years old. And the younger that you start a Roth IRA, the compounding effect of all of those returns will be a lot greater when you are older. For me, I started a little bit later in life. I started when I was around 29, 30 years old. So I have a lot of catching up to do, but I know a lot of you guys are in your 20s. And, I really want you guys to start looking into a Roth IRA, especially if you're in your 20s, because 20, 30, 40 years down the line, you guys will be thanking yourselves for starting one. So let's jump right into the calculations, because a lot of people can't see the bigger picture of starting a Roth IRA. So I'll help you guys take a closer look. Links are going to be in the description for all the sources in this video. So everything I'll be talking about in this video, just go down there. You can find out if I'm talking about fake news or anything like that. All the sources are going to be there so you can fact check it. And so I'm using bankrate.com for my Roth IRA calculator. And let's just start this out with my balance was $12,500 for this year. One thing about that is that I have not contributed my $6,000 for this year yet. Every single year, you can contribute a limited amount. And in 2020, you can only contribute $6,000. Something is wrong with the bank rate contribution limit. This was the limit for 2018, I believe. So the annual contribution limit does change. It's a variable. But the one thing that doesn't change is that at the end of your journey, at 59.5 years old, you can withdraw all of your profits and all of your contributions tax-free. My current age right now is 32 years old, so you guys can input all of your numbers in the same way. For my retirement, I don't believe that I'll be taking it out at 59.5 years old, so I'm just going to leave this at 65. An expected rate of return of 7%. You guys might be wondering, is that low? Is that high? And basically, this is the average rate of return if you guys invest in the S&P 500, which is something that I'm doing. And I'll be going over that later on with you in the video to explain exactly what that is and why is the expected rate of return 7%. So every single year, I'll be maximizing my contributions. And let's calculate this. So a Roth IRA versus a taxable account. So when it comes to my Roth IRA, my retirement balance could be worth up to $843,000. So this is with a rate of return of 7%. And if you guys put that in a taxable savings account, a high yield savings account, you guys might make around $577,000. But now with the new interest rates, that should be a lot lower than $577,000. So this is the power of compound interest. You're going to be investing a smaller amount now, and later on down the line, when you're a lot older, this will continue to grow, and it'll grow at a faster and faster rate the more money that you have in your account. So like I said, if you guys started a lot sooner, like if I could, I would have started when I was 18 years old. And let's calculate the returns for that. So if I started this at 18, contributed let's start this at 0 too. Let's start this at 0. So if I started this when I was just 18 years old and contributed the same amount, $5,000 is something that I think everybody should be able to achieve if they, even started a side hustle. So if you started at 18, you guys might be able to have a balance worth up to almost $2 million. This is not including investing in a 401k or all of these other tax advantage accounts. This is just with one tax advantage account, the Roth IRA. So let's jump back into the M1 Finance Roth IRA and take a look at my holdings right now. So if we take a look at the holdings, you can see that I'm holding all ETFs. ETFs is a great way, especially if you're a beginner, to just start investing, because individual stock picking is not easy to do. Trust me, I've been trying for the last 2 years and I only have a marginal success rate. But what I realized is that starting with ETFs, which is a basket of stocks, basically, it is a lot easier because you're just completely diversified once you start investing in them. All right, so this is what I own. I own VOO, which is the Vanguard S&P 500. I own VTI, which is the Vanguard Total Stock Market Index. So if you own VTI, this ETF is basically the entire stock market wrapped up into a pretty package for you. Next, I own BND, which is the Vanguard Total Bond Market. And lastly, I own VXUS, which is the Vanguard Total International Stock Market. So this investment strategy that I'm using with this combination of ETFs is called the Lazy 3-Fund Portfolio. This is a slight variation of it because I owned VOO before I started this. So what is the Lazy 3-Fund Portfolio? So the Lazy 3-Fund Portfolio is created to perform well in most market conditions. And on top of that, it is very low cost. Those are the two main things that you're going to want when you invest in a Roth IRA. And that is exactly what I did. This strategy was built off of the FIRE movement, the Financial Independence Retire Early movement. And it is also known as the Boggle Heads strategy. So for me, when I started this strategy, I was a newbie when it came to investing in the stock market. And I wanted to choose something that was very simple and very diversified. On top of that, the other advantages as well. So this was the solution that I came up with. And some of the other reasons why I invested in this as well was because the VOO, which is the S&P 500. If you guys don't know what that is, I'll show you right now. So this is the VOO. This is the Vanguard S&P 500 ETF. And essentially, this is the top 500 companies wrapped up all into one ETF. And you guys might be wondering, what are the top 500 companies in America? And here we go. Links are going to be in the description, guys. So if you guys want to really take a closer look at this, it's all going to be there. 3M, a big company in America, also supplying the world with a lot of products and services. Alphabet, also known as Google. You guys know this one. You guys are probably on Google right now. Amazon is on here as well. Ultra Group, making cigarettes for the American people. Moving down here, some big name brands. We got Apple. Right now I'm using a MacBook Pro. I'm using the Apple iPhone. You guys are going to know a majority of all of these companies just because of the sheer size in them. AT&T, one of the largest communications company. Best Buy. Man, I don't know how much longer this is going to be in the S&P 500, but yeah, for now, Best Buy is doing pretty good. So, I'm just going to keep scrolling, and you guys can see that these are, I'm not kidding, the biggest 500 companies in America, multi-billion-dollar companies. And if you buy VOO or anything similar, which just includes the S&P 500, you will have a very similar return. And going back to the annual average return of the S&P 500, historically speaking, this is just the average. It's going to range from around 7% to 10%. And this is not saying that the stock market is going to go up 10% every single year, but some years is going to be down to 5% or a negative number, and then some other years is going to be 10, 20%. All right, so I'll include a link down below, which is from Investopedia. So in this article, what is the average annualized return of the S&P 500? And it goes through all of the data sets. The index has returned an historic annualized average return of around 10% since its inception through 2019. And if you add 2020, I'm pretty sure we're at a positive number when it comes to the S&P 500 year to date. You can see some years it is up over 30%. And in 1997, 31%. In 2013, 29.6%. Like I was saying earlier, and some years in 2008, which was the real estate crash, we lost almost 40% on there. In 2002, there was the dot-com bubble, negative 23%, and so forth and so on. So you guys hopefully are getting a clearer picture of why a lot of people like to invest in the S&P 500. A lot of the people in the FIRE movement, they strictly invest in either an ETF like VTI or VOO. You know, another reason why I like to invest in the 3-fund portfolio is because I can adjust it exactly how I wanted. Right now, I want to invest more in the S&P 500, so I have it at 70%, and I leave my bonds at 20%. Bonds, they typically do not go up in value a lot, and they keep your portfolio very stable. So it is good to have a portion of your portfolio into bonds because they keep it very stable and less volatile. When you come closer to retirement, you're gonna most likely move more of your portfolio into bonds. Right now, I'm still pretty young, 32 years old, so I kind of want to keep it pretty low when it comes to my bonds. So everybody's investment style is going to be a little bit different. So you have to really customize this to how you want it for yourself. But when you're a lot younger, being less in bonds is like the basic rule. And when you're older, you're going to be more into bonds. That's going to be the general rule when it comes to how much bonds you should have in your portfolio. One new strategy that I'm implementing in my Roth IRA is I'm going to invest a little bit less into Vanguard Total Stock Market Index and a little bit less into the total international stock market as well. And I'm going to be putting more into the S&P 500 just because I think that I will get a little bit higher returns if a lot more of my portfolio is allocated to the S&P 500. So the Roth IRA is awesome. It's great. It's a good first step, especially if you're just new to investing and you want to just put your money somewhere instead of leaving it in the bank, because you're not going to see much higher returns from the bank when the interest rates are closer to zero, right? So some of the cons as well, investing in the Roth IRA, there are a few. The first con of investing with a Roth IRA is that you can't write off this investment. So basically, this is a little bit more of a advanced strategy, but there are other tax advantage accounts like the traditional IRA, the 401k, the HSA, all those tax advantage accounts, you can write off your taxes in the beginning, especially if you're a high income earner. And with the Roth IRA, you're investing with after tax dollars, so you can't write that off. But the advantage, again, is that when you do take it out when you're older, you don't have to pay any taxes on all of that profit and all of that compounded interest. The second disadvantage is that if for whatever reason there's like a big health incident in your life or some crazy emergency, if you want to take off your profits from the Roth IRA for whatever reason, you will be penalized. I think the penalty is around 10%, and on top of that, you have to pay taxes on whatever profits that you take out. So make sure that if you are investing in a Roth IRA, this is money that you will not need relatively soon in the future. This is going to be money that you just put away, you forget about it, and when you're old and you can't really think anymore, and you still remember that you have a Roth IRA, that's when you take out your money. The third con of investing in a Roth IRA is going to be the contribution limit. So this year in 2020 is going to be $6,000. Last year in 2019 was about $6,000. Year before that was $5,500. This investing that much in a year is good, but in the grand scheme of things, it's not that much because imagine if you can put in 10, 20,000, imagine how much faster your account can grow. But overall, $6,000 is still going to help you out in the long run. So hopefully I convinced you to start investing in your future, investing in a Roth IRA. I'm investing with M1 Finance. If you guys want to see, what exactly how I set my portfolio up, links are going to be in the description. Just imagine when you're 60 years old, chilling on the beach, living off of your Roth IRA. And on top of that, you're already successful from your other investments in real estate and dividend investing, similar to something that I'm doing. If you guys want to take a look at some of my investments already in the stock market, I'm close to having a $60,000 portfolio, over $2,000 worth of income coming in every single year. And eventually, I want to get this up to $1 million so that I could have like $40,000 worth of income every single year just from my stock portfolio alone, not including my real estate portfolio. So these are some of the things that I talk about in the videos that I make. Hopefully you guys enjoyed them. Subscribe for more content just like this. We'll go watch these videos here if you haven't watched them already. Drop me a like, hit that notification, subscribe to me on my other channel, subscribe to me on my Instagram if you guys want to keep in touch with me one-on-one, and I'll see you guys in the next video. Thanks for watching. I'll check you guys out later.